Welcome to another Explainer. Today, we're opening up the ultimate practitioner's playbook for what is honestly one of the most notoriously tricky areas in accounting, and that is IAS 38. I mean, identifying and valuing things you literally cannot physically touch, it's a massive challenge. So our objective today is to prescribe the exact accounting treatment for intangible assets that aren't specifically dealt with in another standard. We're going to logically follow the complete life cycle of an intangible asset, right from the moment you first identify it, all the way through to how you disclose it to the world.
Okay, let's dive into our comprehensive checklist. We're going to cover scope and definitions, recognition rules, initial measurement, subsequent measurement, disclosures and interactions, and finally, judgments and errors. Let's get right into it.
So, Stage 1, Scope and Definitions. Let's set our boundaries. The core objective of IAS 38 is to ensure we're only recognizing intangible assets under incredibly strict conditions. To even start, we have to define what an intangible asset actually is. It's an identifiable, non-monetary asset without physical substance. Let's break down those critical gatekeepers. First, it has to be an asset, a resource controlled by the entity because of past events from which future economic benefits are expected. But the real gatekeepers here are identifiable and control. To be identifiable, the asset has to either be capable of being separated and sold off from the entity, or it has to arise from strict legal or contractual rights. And control? Well, that means you have the absolute power to obtain the economic benefits and, crucially, restrict others from accessing them. If you can't restrict others, you simply do not have control.
Now, IAS 38 is essentially a baseline standard. It applies to all intangible assets, except when another standard dictates the treatment. If another standard steps in, IAS 38 just steps aside entirely. You do not apply this standard except when you're dealing with inventories under IAS 2, except when you're looking at financial assets under IAS 32 or IFRS 9, except when accounting for deferred tax assets under IAS 12, except when dealing with leases under IFRS 16, and finally, except when recognizing acquired goodwill in a business combination, which falls under IFRS 3.
Moving right along to Stage 2, Recognition Rules and Exceptions. Getting an intangible asset onto your statement of financial position requires passing a highly rigorous algorithmic test. You really can't just capitalize an expense just because you strongly feel it has some future value. For separate acquisitions, you only recognize the asset when all of the following criteria are met. First, it's probable that expected future economic benefits will actually flow to the entity, and second, the cost of the asset can be measured reliably. So the universal baseline rule here is if it generates probable future economic benefits and its cost is reliably measurable, then you recognize it as an intangible asset. It's worth noting that for separately acquired assets, that probability criterion is usually considered satisfied by the very fact that you paid a purchase price for it in the first place.
However, the standard does draw some absolutely hard lines. You shall not recognize internally generated goodwill. You shall not recognize internally generated brands, mastheads, or publishing titles. And you absolutely shall not recognize internally generated customer lists. Why the strict prohibition? Well, because the expenditure on these specific items just cannot be distinguished from the cost of developing your business as a whole. They fail the identifiability and reliable measurement test entirely. There's no getting around it.
But what if you're building an intangible asset internally, like proprietary software? The standard splits this process into two distinct phases, a research phase and a development phase. All research phase costs, those are expensed immediately, gone. But for the development phase, if all 6 strict criteria on this checklist are met, then you can capitalize the development costs. You have to prove technical feasibility, your clear intention to complete it, your actual ability to use or sell it, exactly how it's going to generate those probable future benefits, that you have the adequate resources to actually finish it, and finally, that you can measure the costs reliably. If you miss even one of those 6, that cost hits your profit and loss as an expense.
All right, Stage 3, Initial Measurement, Baseline Rules and Paths.
The absolute baseline rule here is beautifully simple. An intangible asset shall be measured initially at cost. But let's break down exactly what is included and what is excluded. Included in the initial measurement is the purchase price, any non-refundable taxes, and any directly attributable costs to prepare that asset for its intended use. Think of things like legal fees to register a right. On the flip side, excluded are things like staff training, marketing to introduce a new product, and initial operating losses. For instance, if you buy a software patent, the $10,000 legal filing fee is absolutely included in the asset's cost.
But the $5,000 you spent training your staff to actually use the patented software, that is excluded and has to be expensed right away.
Here we hit our first major fork in the road, and it is a policy choice regarding government grants. Let's say you receive airport landing rights for free from the government. Under option A, you can initially recognize both the asset and the grant at fair value. Now, this inflates both your assets and liabilities, unwinding into the P&L over time. Under option B, however, you recognize the asset at a nominal amount plus any direct preparation expenditures. This keeps the initial balance sheet impact totally minimal. The standard gives you the flexibility to choose either, but whatever you decide, you must apply it consistently.
What if you acquire an intangible asset by exchanging it for another non-monetary asset? In that case, you measure the new asset at fair value, unless the transaction lacks commercial substance or the fair value of neither asset can be reliably measured. In those specific exceptional cases, the cost is just measured at the carrying amount of the asset you actually gave up.
Stage 4 brings us to subsequent measurement, how we value this asset over time.
We have another very important policy choice right here for subsequent measurement. You can opt for the cost model, where the asset is carried at its cost, less accumulated amortization and impairment. Or you can choose the revaluation model, carrying the asset at fair value. Now, a huge caveat here. The revaluation model strictly requires an active market for that specific class of intangible assets, because highly unique intangibles, like specific patents or brand names, almost never trade in active markets. Using the revaluation model is incredibly rare in actual practice.
So this logic gives us a critical matrix for subsequent measurement. If an asset has a finite useful life, then you amortize it systematically over that life. Where does that go? It hits the P&L as an expense, unless another standard says it gets absorbed into another asset's carrying amount. Now, if it has an indefinite useful life, then you do not amortize it. Instead, you have to test it for impairment annually. Where does that impairment go? Straight to the P&L as a loss. Finally, if the asset is disposed of or has no future economic benefits at all, then you de-recognize it entirely. Where does that impact go? The resulting gain or loss hits the P&L, but listen closely, you shall not classify a gain on disposal as revenue.
Okay, stage 5, disclosures and links. Let's talk transparency. Transparency is absolutely paramount here to help users understand the reliability and the life cycles of your intangible assets. For disclosures, if the life is finite, then you have to disclose the useful life and the amortization method you used. If the life is indefinite, then you must disclose the carrying amount and the detailed qualitative reasons supporting that indefinite assessment. Quantitatively, you have to disclose a reconciliation of the gross carrying amount and accumulated amortization at the start and end of the period. And crucially, you absolutely must disclose the aggregate amount of research and development expenditure recognized as an expense during the period. Investors really need to see exactly how much you're sinking into R&D that isn't surviving to make it onto the balance sheet.
IAS 38 doesn't just sit in a vacuum. It interacts heavily with a few other standards. IFRS 3, Business Combinations, supplements IAS 38. It dictates that an acquirer actually has to recognize an acquiree's in-process research and development as a separate intangible asset from goodwill, provided it meets the definition of an asset and is identifiable. Meanwhile, IAS 38 defers entirely to IAS 36, impairment of assets, for the actual mechanics of testing those indefinite life assets every year. And finally, SIC 32 regarding website costs supplements IAS 38 by clarifying that website planning is treated just like research. It's expensed, but the application infrastructure development, that gets capitalized, assuming it meets those strict development criteria we talked about.
Finally, we reach stage 6, judgments and errors, the human element.
This is where practitioners really make or break their compliance. So we have to flag a few major areas of estimation uncertainty. First, assessing the probability of future economic benefits. That requires thoroughly analyzing management's best estimate of economic conditions over the asset's entire life. Second, determining whether an asset has a finite or indefinite useful life. Saying an acquired brand name has an indefinite life isn't just a hunch. It requires rigorously analyzing expected competitive actions, legal boundaries, and future maintenance costs. And third, there is significant uncertainty in selecting an amortization method that accurately reflects the exact pattern in which you expect the asset's future economic benefits to be consumed.
And because of those uncertainties, we see practitioners making errors all the time. Mistake number 1, capitalizing research costs. The correct unbending treatment is that all research phase costs must be expensed immediately. Mistake 2,
failing to separate true software development costs from day-to-day maintenance. Routine maintenance costs have to be expensed as incurred. Only costs that add actual new functionality and meet those 6-step criteria can be capitalized. Mistake 3. Systematically amortizing an asset that actually has an indefinite life. The correct treatment there is zero amortization, but a mandatory annual impairment test under IAS 36.
So, the crucial point we want to end on today is this. Take a hard look at your balance sheet. Are your organization's intangible assets truly identifiable, strictly controlled, and reliably measured? Or are they honestly just expensive hopes? Under IAS 38, hope is definitely not an asset. Strict, rigorous adherence to the boundaries, rules, and exceptions we've covered in this playbook is quite literally your only path to accurate and transparent financial reporting. Thanks for joining me on this explainer, and we will catch you next time.